Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, February 25th, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you this morning. We do have some market turbulence. Certainly, we've been seeing a downturn in the market, something we've talked about really for the last month or so, going back to late January, a lot of warning signs in play. And then I think we got some pretty serious confirmation on Friday of last week, and we're going to talk about that a little bit in just a bit. I do want to mention to our Earnings Beats members that I'm going to have kind of a adjusted schedule this week, as I'll be traveling down to Florida for family medical situation. So I'm not going to be real active in the market this week. I'll be keeping track of it and certainly pass along anything I see of significance, but our schedule will definitely be adjusted. Number one, there will be no live trading room on Wednesday. I apologize, but there's just no practical way to get that done. Probably daily market reports will be abbreviated. If I have time, I'll certainly write a full one, but most of the time I expect we'll probably have abbreviated daily market reports. Our weekly portfolio report, I doubt I'm going to be able to get that out this week. And also the chart list, which I normally try to update over the weekend and have ready first thing Monday morning, that might get delayed a week as well. So it might be 2 weeks before I get that back out. Earnings are slowing down. I mean, we still have a lot of the smaller to mid-sized companies that are coming out with earnings, but most of the market moving types of companies have reported. One exception is NVIDIA. NVIDIA will be reporting tomorrow, I believe, unless they've changed the date recently. The 26th, they will be reporting after the close. So we'll keep you posted on that. But that obviously could have a wide ranging effect on many stocks in technology, and especially in the semiconductor area and AI space. So anyhow, just want to make everyone aware that things will be a little bit more of a skeletal schedule for this week, and I certainly appreciate your patience and understanding with that. Also, I want to mention anybody who's new, I'd love to have you hit that like button, subscribe to the channel. I know a lot of you follow us pretty closely every day, and we certainly appreciate the support you give us here on YouTube. And for anyone interested, you certainly could help us out at Earnings Beats and try us out on a 30-day free trial. Check out everything that we have to offer. And I think you'll be surprised at all the market research, education, and guidance that we provide to our members. It wasn't, like I said, much less than maybe a month ago. It was probably right at the end of January that I started talking about, being careful with this market, that there was a lot of stuff going on underneath the surface that you don't see in the, if you're just looking at the you're just looking at the S&P 500 and you see a new all-time high, you don't really think it's any different than any other all-time high. But as I'll show you here today, there are, some things that you need to watch to really gauge the health of the market. And that was the problem at the end of January, is that we started seeing things that just weren't healthy to sustain an advance to the upside. And anyhow, now we've seen the rollover, and I'll show you a couple of charts that really have me concerned in the near term. When I say concerned, I'm talking about just short term. I'm not long-term bearish. I don't believe we're going into a bear market. I think it's possible we could see a 10% correction. I don't believe that it'll go to 20%, become a bear market. But, we evaluate things as they unfold, and maybe that'll be the case. And, we'll, like I said, continue to update everyone as things unfold under the surface of the market. But one of the keys is just the rotation, where the money is going, where it's coming from. And that has been bad for about a month or so, and seems to be getting worse. So anyhow, let's take a look first at what's going on in the market, what happened yesterday in the market. We did see the Dow Jones Industrial Average finish with a gain of 33 points. That was up just a little less than 0.1% yesterday. The S&P 500 fell about 0.5%. NASDAQ down 1.2%. So you can kind of see that movement away from more of the aggressive names like, areas like technology and so forth. Many of the stocks that were flying into option expiration week have absolutely been crushed. Hard to believe, back on Tuesday of last week, we were talking about Palantir when it was at $124. And at our event on Tuesday evening, I said Max Payne was at $83. And I said, listen, it's almost impossible. I'm not expecting Palantir to drop, down to $83 a share. But we were looking at it as a directional move, that we thought Palantir had a lot of risk to the downside. And I said at the time, the way I look at it is I wouldn't buy Palantir. If I was interested in buying Palantir, I would not be doing it at $124, not with Max Payne sitting at $83. And for those of you not familiar with Max Payne, market makers are on the other side of options trades. And so when monthly options come around, that's kind of like the time where market makers have to pay up. And I mean, they make money other ways. They could sell a call when an individual trader is buying a call. Market makers can sell calls, but then buy the stock, underlying stock. So it's a covered call strategy. So they're not going to lose money. But what if, prices go up? And in that example, market makers are riding the stock, Palantir, whatever it is, to the upside because they own the stock. But as they get closer and closer to options expiration, they can cash out the stock. They can then turn and start shorting stocks to bring them back down, to start maybe a rollover where folks start getting a little bit more bearish, like we're seeing now, where now it's just kind of the norm to see a bunch of selling taking place. So they make money on the way up with their long. They make money on the way down because they start shorting. And then the option, which there were tons of in-the-money call options, as of last Tuesday. And where are we now? Now options expired on Friday, but folks do exercise those options so that the bearish impact can still go into the following week. And that's what we teach at Earnings Beat. So here we are a week later. Palantir is at 124 anymore? Don't think so. In fact, I think it closed around 89 or 90 yesterday. And if I'll just give you a quick look at it here. Right now it's up $1 today, pre-market. So it's 91.87. This was $124 5 days ago. That's $33. It's almost 30% on the stock. And you look at it and you say, well, yeah, it's probably just going back to fill the gap. Well, maybe it is, but you got to think, the market makers have something to do with this? I mean, we've seen it enough at Earnings Beats to know that, yeah, market makers have a lot to do with this. They've got financial incentive to drive stocks like Palantir down during option expiration week when they have so many in-the-money calls. So what happens is market makers are on the hook. When it was at $124, they were on the hook in 3 days for any of those outstanding call premiums, they had to pay, and any puts. But they didn't have any puts because the price was sitting at an all-time high. So what happens is, as price moves down, every dollar that price moves down, you don't really have to pay out much more on puts because there's hardly any out there. In the meantime, all of the in-the-money calls at every strike price, all the way up the ladder, loses $1 in value. That's very, very significant. And anyway, the $83 represents the point at which it no longer benefits market makers for prices to go any lower, because they start paying out more in put premium than they save in call premium. So it's that balance, it's that equilibrium. It's kind of like, I always use the analogy of a seesaw. It kind of gives my age away a little bit. But I use the analogy of a seesaw, where the point at which market makers pay the least amount of premium is kind of like that equilibrium point on the seesaw, where up here you got all these in-the-money call premiums and no in-the-money puts. And you get to the point kind of like where the feet are dangling on both sides. That's the point at which market makers pay out the least amount. In Palantir's case, it was over $1.3 billion that was owed. Now, keep in mind, anyone that's played puts over the last month or two, for the February option expiration, they've expired worthless. So market makers have put that in their pockets. So don't think that they're losing 1.3 billion, but they owe 1.3 billion. When prices drop, if they had gone all the way down to 83 by last Friday, the payouts would have been down to about 750 million. It would have been over $500 million worth of savings on one stock. Now imagine how much money is on the table when you think about all the stocks out there, all the ETFs, all the index options. It is massive. And you think these Wall Street firms aren't anxious to take your money? So anybody who's sitting now wondering what the heck happened with their options, hopefully they understand it a little bit better. Anyhow, as far as the rest of the market goes there, get rid of that there. Yeah, I mean, it was a down day yesterday. More weakness in some of the more aggressive areas of the market. The VIX now up to 19 or closed at 19. I can only tell you this, when the VIX gets up over 20, that's where you can start to see some really impulsive selling. Big gap downs, scaring folks more and more as the VIX rises. It can rise rapidly through the 20s and 30s. Don't know if we're going there. Just throwing it out there. You've got to be really careful, because if we get above 20, you could start to see the selling really begin to accelerate in some names, some more aggressive names. And as I warned, we're in the second half of the first quarter now, February 16th to March 31st. Since 1950, the returns during this half of the quarter are literally only 50% of the gains that we see during the first half of the quarter. So there's definitely a skewing towards bullishness towards the first half of the first quarter and not so much in the second half. So anyway, all of those things combined, we just got to be careful. And that's what I've been trying to say for the last month or so. And now we're starting to see a little bit more of it. So yesterday, we had the Dow up, S&P was down a little bit, NASDAQ was down a little bit more. But if you look at this breakout, do you see the technology names bouncing back or discretionary names bouncing back? Because what I see is just further weakness. We had a bifurcated market yesterday, 6 sectors higher, 5 sectors lower. Look at the 6 that were higher: healthcare, real estate, financials, consumer staples, communication services, and then energy. Most of that are more defensive or value-oriented stocks. Then you get to the bottom 5: materials, consumer discretionary, industrials, utilities, interesting, and then technology. So you got more aggressive areas, more growth, especially in the technology area, some in the consumer discretionary, some in industrials as well. But you're seeing much more of that still struggling. So they weren't really bouncing back yesterday. I'm going to show you a little bit more about this in just a minute, but just understand that this is what we need to be watching on a regular basis. Now, when the market goes down, this is normally the kind of configuration we see. We normally see defensive stocks doing better. But what we've been seeing over the past month or so is, even as prices were going up, setting new highs, we were already seeing that rotation. And probably the biggest example and the easiest to visualize is what's been happening in the consumer area, where we've had consumer discretionary way underperforming consumer staples, even though we were going up to an all-time high. And if that sounds like what happened back at the beginning of 2022, it's because that's what happened back at the beginning of 2022. That was one of the many signals. So I'm not trying to say what we're setting up for is another 25 to 30% drop in the S&P 500. It could happen. I don't think it's going to happen, but I think some of that's going to be on the Fed's shoulders. And I've talked enough about the Fed. I don't really need to go there anymore. But if they're so convinced, if they stay convinced that inflation's the bigger problem, and it turns out that the economy's the bigger problem, then they have, in essence, kind of lit a fire under this move to the downside for the U.S. stocks. Let's keep moving. 10-year Treasury yield, give you a quick update here. Big drop today, down 3/4. Well, down 7.5 basis points. How's that? 1.71%. We're down to 4.32. And earlier today, we did have new home, or actually coming up later this morning, we have, no, that's not the right day. Scratch all of that. Let me get back to this. We had the Case Shiller, we had Case Shiller, which came out a little bit ago. The 20 city adjusted month home price index jumped 0.5%. That was better than the prior month's 0.4%. So that was actually pretty decent news. And then the house price, FHFA house price index came out. That rose 0.4%. Last month was 0.3. So we got a little bit of good news in the housing. But that's been an area that's been under a lot of pressure of late. So it'd be nice to see a bigger jump than what we saw. But anyway, that is really the only thing I see so far. And yet the bond market, you're seeing a bunch of folks jumping into the bond market with yields dropping, which again tells me that the bond market is not worried about inflation. In the bond market, what you should see, if we're really worried about inflation, what you should see in the bond market is everybody selling. And as treasury prices go down, yields go up. Always that 100% inverse correlation, always. So when you see the yield coming down, that means folks are buying bonds. When you see the yield going up, folks are selling bonds. And so if you're worried that inflation is going to tick back up again, we're at 3.4%, 3.3, 3.4%, somewhere in there on an annual core CPI basis. If you think rates are going to go back up to 4, 5, 6%, or inflation is going to go back up to 4, 5, 6%, do you really want a 10-year treasury yield that's going to pay you 4.31%, 4.32%? Of course not. You're going to be treading water. You're not going to make any money. So this is a horrible place to be buying. So why are folks buying? Because inflation's not a problem. We've gone now from 480 down to 430 in a month, maybe a little bit over a month, maybe 5 weeks, 6 weeks. And so, this kind of tells me that the bond market is not worried, not like the Fed is about inflation. I think the fact that rates are dropping right now has more to do with the bond market a little concerned with the economy. So anyway, we'll see what happens there. But I thought it was interesting to point out that we've got a pretty big drop. We're now sitting at about a 2.5-month low on the 10-year treasury yield. So S&P 500, go over some of these numbers. You can see yesterday, we've now moved back below both moving averages. However, one thing I would caution you about with moving averages is once you get into sideways consolidation, which is essentially what we've been in since back early in December, these moving averages really don't matter. In a trendless market, price action goes below and above these moving averages many times. Look at how many times over the past 3 months that we've gone above and below both of these moving averages. So the fact that we've come down and gone below the moving averages, it's noteworthy. We're below the moving averages now, but it doesn't really mean much to me. What means more to me are the key price support levels. And so on the S&P 500, I think the most recent low from an intermediate term perspective was what we saw back in early January, maybe the second week of January, when we got down to this low, which was the open on January 13th of 57.82. We're at 59.83. That's 200 points away. It's a little more than 3% on the S&P 500. And we're already down more than 2% on the S&P 500. So getting back down to that level would take us down about a total of 5%. But I think before March is out, I think we could potentially go below that level. And the reason being, I see things that can scare the market, but I don't see much of a catalyst to take the market higher. Unless the Fed comes out and, decides it's flipping again, which, they're the king of waffle. They're the waffle house of the stock market. So who knows? Maybe they're going to flip again. But short of that, I don't know. We've moved beyond earnings, and that's why the first half of the quarter tends to be better than second halves. And that's true in the second and third quarter too, by the way. It gets worse in the second and especially the third quarter, where the second half of the quarter is worse than the first half of the quarter. But I just don't see, with the earnings behind us, kind of the buy on the rumor, and now it's a sell on the news kind of a thing. Still worried about inflation, interest rates, blah, blah, blah. The tariffs, AI, what's going to happen? What if NVIDIA, I mean, they probably are going to report decent, but what if they give kind of sketchy guidance? I mean, that could really wreak havoc on the market. So I just see more reasons why we could go down than why we could go up. And we've been talking about many of those over the last month or so. Let me take a look at the NASDAQ 100 real quick, and then I'll show you the consumer discretionary and consumer staples that I was referring to earlier. But you can now see two really big down days. We haven't seen this in a while, probably not since back in mid-December. And you can kind of see that led to some more weakness ahead. And that's kind of what I see. Where, it's not like we're not going to get a bounce. I believe we'll get a bounce at some point. Usually the latter part of February, early March tends to be, one of the more bullish times during this second half of the first quarter. So maybe we get a little bit of a bounce after, maybe after NVIDIA's report, maybe we'll see a bounce. But then I think you might want to hunker down, because I think if we do get a bounce, get back up to these moving averages, or maybe even slightly above, I think we could see another swoosh to the downside. And I'm not saying we're going to bounce. I mean, market can take on all kinds of different looks. I believe short to intermediate term, we're going down. I think by the end of the year, we'll be fine and sitting at new all-time highs before the end of the year. But short term, I think we're going to have some problems. So let me show you this chart on discretionary and staples. So this is the last 5 days. I mean, we could go back even more. I'll go back 10 days. I mean, really, I could show you on and I will show you on a daily chart how bad it is. But here you can see the XLY moving down, rallying back. And then for the last 6 days or so, it's really been under pressure during the day, and it's been selling off, especially look at Friday. It was a gap up, and then it was a sell-off almost all day long. This is what distribution looks like. This gap down here and this gap down here, half of the move on this day was probably the gap down. Then we gapped down and rallied, then gapped up and rallied. I mean, none of this really looks like distribution to me. This looks like distribution on Thursday, and then this on Friday. It's clearly distribution. So look at what the XLY looked like on Friday. And now let me show you what the XLP looked like on Friday. Thought I had that 5-day up. So here is what happened on Friday in consumer staples. Started off at pretty much the low of the day and went up all day long. And on Friday on the XLY, we gapped up and went down all day long. The spread between, if you forget about gaps, if you just look at where we opened and where we closed on Friday in these two groups, the difference between the XLY's decline and the XLP's advance was the 10th highest decline, or I should say maybe the 10th worst decline since the bottom in 2009. Since the bottom of the financial crisis in 2009. That's 16 years. Friday was the 10th worst day. And look at how many really rough periods we've had since 2009. We had a couple big declines in 2010, 2011, nasty correction through 2015 into early 2016. Bear market, we had a correction beginning of 2018. We had a trade war related cyclical bear market at the end of 2018. We had the pandemic in 2020, the cyclical bear market in 2022, the correction in 2023. And yet Friday was the 10th worst day when you compare discretionary to staples since 2009. That's saying something. And if we get another one of these days, we're in big trouble, because you just don't see these days very often. I think the XLY from open to close went down like 2.75%, and the XLP from open to close went up like 1.25 or 1.5. So when you take that difference, which was a little over 4%, there have only been 9 days worse than that since March of 2009. And by the way, those 9 days, 8 of them were during a bear market. 1 of them was during a correction. None of them was during just, a period where we just go back up to all-time highs. So this means something. And when I said earlier that we do a lot of research at Earnings Beats, this is kind of what I'm talking about. As soon as I saw that day, I immediately spent the weekend researching to see how many times and when we've seen action so bearish. It's only happened 9 other times when it's been worse. 9 other days. How many trading days? 252 in a year. And we've gone 16 years. So that's a lot. 10 would be 2,500. So that would be probably 4,000 trading days. Friday was the 9th worst out of 4,000 trading days. Anyhow, we'll see how things play out, but everybody needs to be aware of that. Here, the S&P 500. This is where I just wanted to show what's going on. This is the XLY versus the XLP. And look right here, we were at a high. So as we were going up, notice this ratio was going up with it. That's a good sign. That's bullish. That tells us that the rally is still sustainable. The positive correlation between the S&P 500 and the ratio of discretionary versus staples, it is one of the tightest positive correlations that we have in the market. That's why I follow consumer stocks so closely, because they tend to move together. When they start to move apart over an extended period, you need to be worried. In this case, or maybe not worried, maybe it's at the bottom. The S&P is going down and this ratio starts to turn back up. Folks start getting into discretionary. I shouldn't say folks, it's Wall Street. Nobody else is getting into discretionary, not when it's falling through the floor. So Wall Street starts building positions at the bottom and they start unloading positions at the top. And I don't know how this could be any clearer. Here we go, right up here to a new high last Tuesday. That was when we did our options expiration, our max pain event. And we set a new all-time high. And look what was happening to this ratio, falling apart. Look what's been happening to growth versus value, falling apart. I mean, I don't know how it can get much worse visually than what I'm just showing you here on this chart. And there's a history. It looked just like this back at the end of 2021, if you will go back and look. The high was set in November of 2021, growth versus value. And in December of 2021, right before the top, the entire month of December, consumer staples went up 10% and consumer discretionary 0, flat. 10 percentage point difference in the defensive group. So should we be shocked that in January we started a bear market? Probably not. And that's why I don't think we should be shocked if we see this develop into at least a correction. In fact, I would put odds on a correction at this point at least 50%. Again, that's not a guarantee. Maybe we go right back up to a high, but that's not what the signals are saying. So I believe you got to pay attention to the signals when they all start lining up. Got a lot of sentiment issues. Market's been way bullish in terms of consumer, equity only put call ratio, CPCE. Been talking about that for a while, how it's been in very, very bullish territory for a while. And that is a contrarian indicator. When you get very, very bullish, the market usually tops. When you get very, very bearish and everybody's playing puts, nobody wants to touch a call, that's when you're probably bottoming. So all of these things coming together. Unfortunately, I'd like to say, hey, we're going to go right back up to an all-time high, but I think we have a difficult period ahead. Anyhow, if you like what we do at Earnings Beats and you like today's show, you can go over to earningsbeats.com. Couple different things. You can sign up for a 30-day no-cost trial. That's 30 days. I think the next 30 days are going to be worth a $0 investment to get our thoughts day after day after day. And then if you scroll down, if you don't want to, subscribe at this point, we have a free newsletter, no credit card required. Tens of thousands of folks have joined us here. Name and email address, all it takes. We have a report, article, whatever you want to. It's really 2 paragraphs in a chart, just to simplify it. Twice a week. Sometimes it's a stock. Sometimes it's an earnings gap we're highlighting. Sometimes it's a breakdown. It could be a breakout. Could be a trend line. Relative strength we talk about a lot. Could be a number of different things, but I try to make them educational. And then if you decide, hey, I might want to trade one of these stocks, That's up to you. But sometimes these are set up for trades as well. Anyhow, make sure you check those out. I'm going to get running in this thing just about on time because I am literally about to jump in a car and head to Florida. So anyway, be careful out there. I know these kinds of markets are no fun unless you're on the short side. I'm not shorting because I still believe 100% or 98% that we remain in a secular bull market that could just be going through some short-term troubles here. And I don't really like, maybe it goes down 4 or 5% and then goes right back up. Maybe it goes to 10%. Maybe it goes to 20. I'm not thinking 20%. I'd probably put that around 10 to 20% chance. I really don't think that's as likely, but I think 10% is a very real possibility. And by the way, I didn't show you, but the 20-week moving average on the S&P is somewhere around 5,600 or a little above 5,600. That would almost be a 10% correction if we got back down to that level. So just some food for thought. Anyhow, if you like the show, click that like button, subscribe to our channel. We'd love to have you. Follow us. Certainly no obligation on YouTube and no obligation on our free newsletter. But again, if you want our best service, you want our guidance on a regular basis, day in and day out, 30-day no-cost trial, check us out. You will have to give credit card for this one, but we will not charge your credit card. We will let you know before your 30-day trial is up to let you know whether, hey, we'll give you a special deal on the annual. You're going to be charged X if you stick with a monthly. And we give you an opportunity to cancel. So you're not going to forget about it. We're going to reach out to you. But honestly, if I don't feel like we're a fit, no harm, no foul, cancel. We really want our members to feel like they're getting great value from our service. Anyhow, that's it for me today. Let's see. I think the market did just open. So let's see if let's go to intraday. Yeah, starting off a little bit weak here. NDX, let's see. Yeah, NDX down a little bit. IWM holding up just a tad. Overall, this has been a worse performer, though. Small cap still remaining under pressure. You would think that with rates coming back down, we'd start to see some outperformance in the Russell. But I think what we're really looking for is not so much a drop on the 10-year side of things, but a drop on the Fed funds side of things, which is what the Fed controls. So until the Fed starts to turn, I think we could have some problems remaining, even on a relative basis with small and mid-sized stocks. All right, that's it for me. Listen, everybody, have a great rest of your day. Again, for those that weren't here at the beginning, I am going to be traveling to Florida for a family medical issue. I'll be gone probably, looking at this point, to be coming back this weekend. So some of our services may be a little bit more skeletal this week than normal. DMRs are likely to be very brief. That's our daily market report. Tomorrow's live trading room, I'm not doing it. I don't have access to be able to do that tomorrow. And weekly portfolio report at the end of the week, probably not going to be sent out. If it is, it might be late Sunday, early Monday morning. I just don't know how much time I'm going to have. And the chart list, which normally get updated over the weekend, since I'm going to be traveling all day on Saturday coming back, chances are that I won't have enough time to get everything done. So that might get pushed back a week as well. So I do apologize for any inconvenience, but certainly appreciate your understanding. Have a great rest of your week, everybody. Happy trading.